Imagine Ernie Chan late one night in a small Chicago apartment, staring at his algorithm's blinking cursor. The screen flashes by signals just as the market suddenly swings. This isn't guesswork or gut feeling, it's a formula born from raw data, tested strategy, and gritty real-world trials. But how do these trading algorithms actually come to life? What makes some systems win while others crash and burn? Let's crack the infamous mean reversion strategy. Sounds simple, but Ernie reveals what really happens when prices snap back, and why timing can be your best friend or worst enemy. Ernie dives into Alcoa's stock, showing how its price doesn't wander randomly, it oscillates. By tracking these swings, his algorithm predicts when the price will rebound, snapping back after extreme moves. This wasn't guesswork, it was methodical pattern detection on real data from NYSE trades. Imagine pricing like a rubber band stretched tight after a tug. The further it's pulled, the stronger and faster it snaps back. Mean reversion strategies exploit this elastic tension in prices, betting on that inevitable rebound rather than a random leap. When the market overreacts, the payoff comes as prices recoil sharply. Ernie's careful backtest show that sticking strictly to the strategy despite the noise yields consistent wins. The big surprise, this simple idea can outperform complex models when disciplined and timed right. Momentum feels like chasing winners, but Ernie warns there's a catch: markets shift, and yesterday's hot stock can freeze overnight. What separates a smart momentum play from a costly trap? Post-2008 crash, tech stocks surged, and momentum strategies swooped in chasing those rocket rises. Ernie shows just how fast these picks picked up steam, but also how quickly some reversed. Blindly riding momentum without context led many models to crash and burn. Think of momentum trading like surfing. Catch a wave just right and you soar, but mistime it and you're wiped out by the crushing surf. Those waves shift with changing market regimes, so timing and adjustment are everything. Ernie's genius was adding adaptive filters, dynamic switches that sense when the wave changes direction. These filters reduce exposure during volatility spikes or regime shifts. It's the difference between getting wiped out and gracefully riding the tide to profits. Strategy's only half the battle. Ernie pulls back the curtain on risk control. Because no matter your edge, poor risk management turns winning trades into painful losses. In one striking example, Ernie discusses how using fixed stop-loss orders saved his trading account from a massive market drop. By defining clear exit points, he kept emotions out and locked in healthy capital preservation, letting him trade another day. Think of your portfolio like a medieval shield forging with many metal plates. Diversification spreads risk so one blow doesn't shatter your whole defense. Ernie preaches spreading bets across different strategies and instruments to smooth out unpredictable market punches. Crucially, Ernie introduces regime-aware risk measures, adjusting position sizes and stops based on market volatility or structural shifts. This dynamic helmet keeps you far safer than rigid rules, especially when the market decides to throw curveballs. Remember Ernie's blinking cursor that first evening? That glow isn't magic, it's the product of strategies built on patterns tested rigorously and risk managed with care. Algorithmic trading isn't just about cold numbers, it's about crafting rules that dance with the market's rhythm. So here's your shot: try analyzing a simple stock's price swings today. Start small, test your edge, and watch your own trading system come alive. Subscribe for more book summaries like this one.